Hi Digital Chiefs. So today I'm going to talk through reasons why you may not want to raise investment capital. So number one, I'm going to kick off with a really obvious reason. You get to keep more of the equity if you don't go out and raise external capital. i.e., when you come to selling the business perhaps later down the track, you get to keep more of the profit. Number two, it's a bit of a distraction. If you've taken my online fundraising course, you'll know that I go into quite a bit of detail about the process. It can easily take 6 to 12 months to raise a round of funding. Before you're even ready to speak to investors, you should be preparing your investment documents, i.e. your deal room, which should contain your investment deck, your financial reports, and perhaps also your CVs. Then you need to prepare a list of investors, i.e. a list of targeted investors that are strategic to your business. Building an investor list requires a fair amount of research, so that in itself can take a little bit of time. The middle part, where you're finally ready to speak to investors, cold emailing, perhaps asking for introductions, and then booking in those meetings, sitting down and having your coffees or your Zoom meetings, that itself takes a fair amount of time. And then, of course, replying and following up with those investors. Sometimes it takes multiple follow-ups to get to that investment interest. Perhaps you're also doing a little bit of media to build up the buzz for the round. That middle part of approaching investors can take multiple months. And then, of course, once you have investor interest, you need to sit down and negotiate the terms, finalize the terms, and really secure the funding into the bank account. The investment doesn't really end there. Once you've closed the round, you will have reports to deliver on a routine basis. Sometimes this is monthly, sometimes this is quarterly, and then also perhaps board meetings depending on the size of your company. You'll have reporting to routinely do and deliver. Following those reports, you'll be replying to questions again and following up. I've mentioned this multiple times in the past. Raising investment capital is not a transaction. It is really building longer-term relationships that are ideally strategic. Hopefully you've taken my advice from these videos and my online course and targeted smart strategic investors. If unfortunately you haven't raised from strategic investors, then you may be actually getting a lot of unqualified and unhelpful advice, in which case you will need to manage. Again, all of this really chews up a lot of time and is quite distracting for an entrepreneur. If you get along with your investors, have a similar vision for the business and values, then it can be one of the most rewarding relationships you'll ever have. If, however, it goes the other way and your investors don't get along with each other or with yourself, then unfortunately you will be held responsible for umpiring the situation. So the third reason why you shouldn't raise investment capital, I've sort of already touched on, and that is faster decision making. With new investment capital and new parties involved in the business, there might be board seats, there might be voting rights, there might be notices that you must provide investors in order to make key strategic business decisions. This could include limitations on hiring, for example. While I don't see investors getting overly involved when it comes to hiring decisions, what can actually happen is that there is a delay to hear back from the investors. So much so that sometimes the company ends up losing the actual talent they had in mind. This chews up more time with the entrepreneur having to go out and start the entire hiring process again. Other key decisions that you retain might include you not feeling any pressure to grow faster than you feel comfortable with or that is right for your business. So the fourth reason why you shouldn't raise investment capital is that you still need to go out and bring customers in. Investors are looking for a return on their capital, a 10x at a bare minimum. That means whatever capital you raise, you need to go out and bring in at least 10x that of customers. This is why there is more reporting, there is more pressure for you to grow and to go out and raise the next round at a higher valuation. We often forget that VCs have their own KPIs to meet, whether that be performance of their portfolio to their own investors or corporate performance if they're a corporate venture capitalist. Now, if I haven't turned you off enough and you've decided to still go out and raise external capital, you might want to check out my online course, Raising Your First Round of Funding, so that you are spending time targeting and speaking to the most strategic smart money.